Very good morning, guys. Warm welcome to the best lectures of FM, SM, and Audit nationwide. Yes, guys, welcome to our YouTube channel. Hope you guys are doing good. Continuing with mega marathon revision series of CA Inter Audit. We have completed till now many chapters. We have done chapter number 1, 2 is strategy planning program, 3 identifying risky areas. Chapter number 4 is what audit evidence. Chapter number 6 we did audit documentation. Chapter number 7 we are just completing the audit, completion and review. And after completion and review we will give audit report, and then almost entire core audit will be over. Core means the main audit. So today's chapter is all about completion and review. Let's start right away. Those of you who don't know, these are audit revision lectures in only English. Yes, Hindi ones are already uploaded. These lectures are in no way substitute to the regular or fast track lecture. Of course, you have to do them. After that, if you do this, your confidence will be skyrocketing very high. For those of you who are asking from where this revision is done, this is done from the magic book. It covers almost entire subject in around 85 odd pages. Okay, so this is the magic book. Can we start, guys? Yes. Completion and review means all the essays which are relevant in completing the audit. Can we start? Yes. Starting with number 1 essay is essay 580. We have 6 essays here. What is essay 580? Written representation from management. Okay. Always remember why this is a nice essay. This is a nice standard. Why? Written representations come in original form. So they always say original is better than photocopy. Number 2, they are given by those who are responsible for preparation and presentation of financial statements. Okay. So they are coming from authorized people, and it's directly coming to auditor. So it's more reliable than coming indirectly. Third, it is in original form. Fourth, these are written. Written is always more reliable than oral. So these are few reasons that written representation is very good. What we generally tell management to write, okay, we tell them, see, written representations are written statement given by management to auditor to support certain matter or confirm certain matters. Here, written representations are written statement by management to the auditor to confirm certain matter or support other evidence. Let's take example. Okay, for example, financial statements are prepared as per FRF. You know, but when management writes, your evidence will be little more. So they will write, we have prepared financial statement as per FRF. 2, there are no frauds in the company. You know, but when they write, it is always little better. Third, all subsequent events are disclosed. Subsequent events means events occurring after balance sheet date. All related party transactions are properly shown. Okay. There is no impairment loss in the company. All the legal cases are properly disclosed to the best of knowledge and belief. We know all these things, but when someone tells, the assurance is even more. Many times, let's take a parallel example. Okay. You want to join a class, okay, that this sir is good, this teacher is good, this class is good. You ask your friend, so you have decided you will do it from here only. But when your friend also tells, your assurance will be even more. So written representations are written statement by management to auditor to confirm certain matter or support other evidence. What is confirm certain matter? You know, there is no impairment loss, but when management will write, okay, the assurance will increase. Support other evidence. You want evidence about related party completeness, that related party are complete. You know it, but when management will write, it will support your evidence about completeness of related party. Anything you can tell them, please write that changes in accounting policy if it is done, change in method of depreciation is done, effect is properly classified, described, disclosed. They will write, the assurance will be much more. I hope you are able to understand. Written representations are written statement by management given to auditor to confirm certain matter or support other evidence. Okay, and when they confirm, the assurance is much higher because it's coming from those who are responsible for preparation and presentation. One more thing here, they should in no way affect what? Our audit procedure. Remember, written representations are never primary evidence. They are always secondary evidence. Okay, means it will in no way affect the audit procedure to be done. I still have to do the audit procedure, but this will give me that extra cushion, extra comfort. Very easy. Understood till here? Now everything is super simple. Come here. If you want to see few written representations here, we will read 5. Financial statements are prepared as per FRF. I told you. All subsequent events are disclosed. All legal cases are disclosed. All related party transactions are shown. All the frauds are properly shown. Okay, same. Okay, there is no doubt about going concern. We know these things, but when someone will give assurance, our assurance will be even more. Okay, let us read. Come here. Written representations are written statement given by the management to auditor to support certain matter or confirm other evidence. 2. Audit evidence is all the information used by auditor in arriving at a conclusion based on which his opinion is based. What is audit evidence? All information arrived by auditor. One such evidence can also be written representation. 2. Written representations should come from those who are responsible for preparation and presentation of financial statement, that is the management, the CFO. Written representation do not give sufficient and appropriate evidence on their own. That is why I said it is always a secondary evidence. It can never be primary evidence. They will not give sufficient and appropriate evidence. I should collect evidence. They can act as a supportive evidence. They are never ever primary. Okay. And it doesn't affect nature, timing and extent of audit evidence to be obtained or audit procedure to be performed. We have to do our normal procedure. Get our evidence. This is an additional thing. Okay. This is the extra thing. This will give you extra cushion, extra comfort. Okay. Come here. First question which can come. Very simple standard, very easy standard, be rest assured. Objective of auditor regarding WR. Why should I take written representation? Okay. Number one, to respond appropriately. Respond appropriately to two cases. To written representation given by management, not given by management. If they give, tell me what will happen. My assurance will increase. But if they don't give, tell me my risk of material misstatement will be high or low. Of course, high. Okay, I need to collect more evidence. Okay, different ways. My risk will be little high. I will feel is there any fraud or not, about which we will learn later. Number one objective of WR is to respond appropriately to two situations, to WR given by management, to written representation not given by management. Read nicely. To written representation given by management, or if management doesn't give written representation, in both cases I have to respond. To obtain WR, tell me if I get WR, what will happen? It means management has fulfilled their responsibility for preparation of financial statement and completeness of information given to auditor. It means management has fulfilled two responsibility. Number one, financial statements are properly prepared as per FRF and they have given all the information. So I will get more assurance. Third, to support other evidence relevant to financial statement or specific assertion in the financial statement. Okay, support other evidence. Let's take example relevant to financial statement. All A's are followed. All accounting standard are followed. You have given written representation. It's related to financial statement. Specific assertion means what? Related party are complete. There is nothing hidden in related party. All related party are shown properly. Related party completeness. I got comfort. Okay. So very simple. Tell me, why do I need WR? Rows. Objective of auditor regarding written representation are to respond appropriately to ROSE. Rows is there? No, rows. Why should, or what's the objective of auditor for WR? Rows are to obtain to respond appropriately, okay, to WR given by management or not given by management. What is O? To obtain written representation. What is SE? To support other evidence. I hope you are clear. Very simple. Tell me, what are objectives of auditor regarding WR? Rows. Number one, R, to respond appropriately. O, to obtain written representation, okay, and SE, to support other evidence. I hope you are clear. Read nicely. 5-second break. What are objectives of auditor regarding WR? Rows are to respond appropriately, to obtain written representation, to support other evidence. Read nicely. Over. Tell me, what are objectives of auditor regarding WR? To respond appropriately. O, to obtain written representation that management has fulfilled its responsibility for preparation of financial statement and completeness of information, to support other evidence, okay, related to financial statement or specific assertion in the financial statement. Easy? Come here. Can we ask WR from others? Management will ask. See, in certain fields, management don't have complete knowledge. So they will ask from expert who are expert in that field. Given in English. Management may ask others who have specialized knowledge about that field. Number one. internal counsel regarding legal cases. See, if you want to know completeness of legal, you can ask the legal team. Internal counsel, you can take WR. Okay, management can take WR from internal legal team regarding legal case. Actuary, you know what's actuary? Okay, a provident fund will be how much, gratuity provision will be how much. See, gratuity PF is given at the time of retirement. Okay, but every year we need to book certain expense. Okay, because we are getting the benefit every year. So as per the matching principle, we need to book how much, that actuary will tell. So I will ask actuary. Third, staff engineer about environmental liability. Any environmental liability, staff engineer. Can we use this? Of course. Okay, management may ask others who are expert in their field. Whom they will ask? IAS, internal counsel, actuary, staff engineer. Internal counsel, actuary, staff engineer. Internal counsel, actuary, staff engineer. Clear? Okay. Can management use the language to the best of knowledge and belief? To the best of knowledge and belief, all related party transactions are complete. To the best of knowledge and belief, okay, subsequent events are disclosed. To the best of knowledge and belief, there are no frauds done by the company or on the company. Yes. Anyways, you are giving reasonable assurance. If you are not giving complete assurance, absolute assurance, how can you expect from management? When you do, it's okay. If they do, it's not okay. Not fair. Okay, allowed. They can write qualifying language to the best of knowledge and belief. Why? Because we are also giving what assurance? Reasonable assurance. So they will write best of knowledge and belief. Most important MCQ. Date of written representation should be as near to the date of financial statement as possible. Okay, don't keep it very far. It should be as near to the date of financial statement as possible. Written representation can never come after auditor's report. Okay, you have made report based on written representation based on these facts, so it should be before the date of auditor's report. That is what. Date of written representation should be as near to or as near to or as practicable to the date of auditor's report, but not after. Why? Because your report is based on written representation. Okay, simple. Now two more questions. Doubt regarding reliability of written representation. If there is doubt regarding reliability of written representation, they are saying there is no impairment loss. But you found impairment loss. What you will do? We will do other audit procedures to find out the actual impairment loss. Okay, and tell them to correct. But if they don't correct, we will re-evaluate. We will tell them, please show impairment loss. This entry has come. But if they don't correct, we will re-evaluate the dice of management. Dice, you understand? We play dice. Okay, we will understand the diligence, integrity, competence, and ethical values of the management. Okay, read here. If written representations are inconsistent with the evidence, they are saying there is no impairment loss. They are saying there is no fraud, but there is a fraud. Auditor will do more audit procedure to resolve the matter, do more procedure to find out exact amount of fraud, to find out exact impairment loss, so we can make a journal entry, and the matter is still unsolved. They are not solving it. We will re-evaluate, reconsider the dice of management. What is dice? Diligence, integrity, competence, ethical value. Underline. We will again reconsider dice, diligence, integrity, competence, ethical value of the management. If the auditor concludes WR are not reliable, after that, if you feel WR are not reliable only, they have given everything, but nothing is reliable, everything what they have told is false, okay, then appropriate action as per SS 705. Okay, if you feel mistakes are material, then qualified, material and pervasive adverse report will come. One last time. Okay, if you have any doubt regarding WR, written representation, then we will do other audit procedures to find out the exact amount. If the matter is still not solved, we'll tell them, correct it, sir. You told there is no impairment loss. You told there is no fraud. Please correct it. If they don't correct, matter is still unsolved, we will re-evaluate the dice of management, diligence, integrity, honesty, competence, ethical values of the management. Okay, if auditor concludes in the end WR are not at all reliable, we will consider the impact on audit opinion as per SS 705. Understood? Okay. What if they don't give only WR? You go to management, Mr. Harish, please write WR of Reliance, okay, written representations. They are saying, but anyways, you will do the work. Why do you need? It's an additional evidence. Our standard is told, SFI80 is told, okay. But if they don't allow only, then number one, A, discuss the matter with management. We will talk with management. Why are you not giving WR? 2, re-evaluate the integrity of management. and effect it will have on WR, oral or written or audit evidence in general. Okay, if they are not giving, re-evaluate the integrity of the management, and effect this will have on audit evidence. Tell them ROMM will be very high. Are you clear? And if I don't get evidence, I can also give disclaimer report. Take appropriate action, including possible effect in auditor's report as per SS 705. If you don't get audit evidence by other means also, you can give disclaimer report. Why? Because all the accounts you are not getting evidence. Not one. You feel mistakes could be material and pervasive because they are not writing only anything. Understood? So tell me here, if they don't give, what's the first thing? Discuss the matter with management. Okay, after discussing, re-evaluate the integrity of management and effect this will have on audit evidence. Okay, and third, take appropriate action, including giving disclaimer report. Why? Because all accounts you are not getting evidence. Okay, why are they not giving evidence? It's not for one account. The effect could be material and pervasive because they are not writing only. Here they have written, it is wrong. Here they are not writing only. Very simple. So tell me, if management doesn't give WR, then what we will do? Discuss the matter with management, re-evaluate the integrity of management, and effect this will have on written representations. Okay, and last, take appropriate action, including giving disclaimer report as per SS 705. Very easy standard, nothing great. Come to second standard, little nice. Okay, subsequent events. Next in the list is SA 560, subsequent events. What do you mean by the word subsequent events? All the events occurring after the balance sheet date but before the date on which audit report is prepared. So it basically means, okay, all the events after the balance sheet date but before the date on which financial statements are signed by auditor. All the events, usually, okay. First of all, how to remember this standard? See, assume 5 is a balance sheet date. So after 5, what will come? 6. So after balance sheet, what will come? Subsequent events. Usually, let's take an example here. 31st March 2024 is the balance sheet date of which year? 23-24. 23-24. Tell me anything which will happen after that, after 31st March will come in which year? Not 23-24 but 24-25. Yes or no? Yes or no? Absolutely wrong. Okay, some events though they happen in 24-25 after 31st March, but they will still come in 23-24. That is what this standard tells us. That is what is AS4 in your syllabus. Contingencies and events occurring after balance sheet date. Okay, so 31st March 2024 is which date? Balance sheet date. Okay, then come 20th June is the signing date of audit report. Is the signing date of audit report. Okay, then 15th July, financial statements are published. Okay, financial statements are published on which date? 15th July. Okay, to whom? Shareholders. Okay, approval forget. 31st March balance sheet date. 20th July is the date on which signing is done of the audit report. Okay, 15th July they are published to the shareholders. It should be done before 30th September if you don't know, because that is the date of AGM, annual general meeting. Okay, but forget, one more time let us remember the dates. Okay, see, before explaining this standard or this essay, that is essay 560, how to remember? 5 is balance sheet. After 5 what will come? 6. After balance sheet will come subsequent event. Before understanding this standard on auditing in detail, we should know AS4. What is AS4? Contingencies and events occurring after which date? Balance sheet date. So come here, balance sheet date is 31st March. After that, audit report is signed on 20th June. Okay, 15th July it's published to shareholder. It should ideally be done before 30th September. Okay, AGM should be held before 30th September. This much is clear. In between all date forget. Okay, come here now. What do you mean by contingencies and events occurring after balance sheet date? AS4. AS4 deals with all events which occur after the balance sheet date but before the date on which financial statements are signed by auditor. Okay, any event which occurs after the balance sheet date will come in next year. No, absolutely wrong. Some events though they occur after the balance sheet date but they have to be shown on the balance sheet date. Why? These are known as adjusting event. Okay, AS4 tells whatever are subsequent event, divide into two parts: adjusting, non-adjusting. Adjusting, non-adjusting. Come to adjusting. Adjusting events, though they occur after the balance sheet date, but they are to be shown on the balance sheet date. Okay. Non-adjusting, of course, if they occur after, they are not to be adjusted. They will be shown in next year only. One last time, what do you mean by adjusting event? Though they occur after the balance sheet date, but they are to be shown on the balance sheet date. Means though they occur in 24-25, but they are to be shown in 23-24. You will ask me why. Stay tuned. Okay. Though these occur after balance sheet date, but these are to be shown on balance sheet date. Number one, okay, required by law proposed dividend. Okay, first item is proposed dividend. Proposed dividend is declared in June, July, August, but you have to show it of last year. Why? Because it is actually of last year, so you cannot show in 24-25. It is the dividend of 23-24, so it should be shown in 23-24. Two, require going concern. Okay, if it affects going concern, what's the use of showing next year? Next year company will only not remain, so anything which affects the going concern should be shown in last year. Okay. Third, very important, provide further evidence of conditions existing on balance sheet date. On balance sheet date, there were some conditions, okay, in balance sheet date. Now you got further evidence of those conditions. Then you have to show it on balance sheet date. Why? Because it is giving you further evidence of conditions existing on balance sheet date. On balance sheet date, there were some conditions, okay. Now you got further evidence. Let's take two examples, okay. Number one, debtor, there was a doubt, so we did provision for bad and doubtful debts on balance sheet date. Balance sheet date, you did provision for bad and doubtful debts because there was a doubt on debtor. Now in July, he became insolvent. Okay, before signing the audit report, we have to show it last year only. Entire amount bad debts, entire loss you have to book. Why? Because it is giving you further evidence of condition existing on balance sheet date. On balance sheet date, there was a condition that debtor could become insolvent, and finally he became. Okay, let's take example number two. Okay, you will understand. A legal case. Okay, we knew we might lose this case or win this case, so we did some provision, because what if we lose? Okay, so on balance sheet, and finally the verdict of the case came in July and we lost the case. We had to pay compensation of 20 lakh. We have to book it last year. Why? Because it is giving you further evidence of condition existing on balance sheet date. Okay, so in three situations, though they happen next year, they have to be shown last year. It is all taught in AS4. I am just doing revision. Number one, required by law. Example, proposed dividend. Number two, affects the going concern. Number three, provides further evidence of conditions existing on balance sheet date. On balance sheet date, there was condition and we got further evidence of those conditions. Come here, come here, come here. All events except adjusting are non-adjusting. Whichever are not adjusting are non-adjusting. Divide into two parts. Okay, material, immaterial. Whichever are not adjusting are non-adjusting. Material, show in board of director report. Immaterial, ignore. Let's take an example. There happened fire in the month of May. Okay, but fire is not so big that it will affect the going concern. Okay, so it's a material thing. I will disclose in board of directors report. But anything sale is done, purchase is done, those are immaterial things. Just ignore. Just ignore. So till now we have not started SA 560. All I was doing was revising AS4, accounting standard 4, contingencies and events occurring after balance sheet date. One last time. Okay. So AS4, what? Contingencies and events occurring after balance sheet date are those events that occur after balance sheet date, but they are to be adjusted on balance sheet. Okay. Start. Divide into two parts. Adjusting, non-adjusting. Adjusting, though they occur after balance sheet date, but they are to be adjusted on balance sheet date. Number one, required by law, proposed dividend. Number two, affects going concern. Number three, provides further evidence of condition existing on which date? Balance sheet date. Okay, so required by law, going concern, further evidence of condition existing on balance sheet date. Okay, example, debtor turn insolvent. Okay, or legal case lost. All the events which are not adjusting will be shown next year. But if it's material thing, disclose in board of directors report for that year. Immaterial, ignore. Clear? This is AS4. You have to remember mainly this point only. Now, in this essay, now we are studying standard on auditing. If your AS is clear, you can also start from here. This standard basically deals with two things. Okay. all the events that occur after the balance sheet date but before the date of auditor's report, and after the date of auditor's report. Understood? One more time. See, all events occurring between 31st March to 20th June, the signing date. After 31st March but before 20th June, the signing date. Or all events occurring after the sign is done by what? Auditor. Okay, after the signing date. Okay, so come here, come here, come here. Now let us read what is given. Events occurring SFI 60 subsequent event. Welcome back. Events occurring after the balance sheet date and before the date of auditor's report, and facts which come known to the auditor after the date of auditor's report. After the date of auditor's report also, if we come to know of any event. Objective: to obtain sufficient and appropriate evidence that all the events that occur after the balance sheet date and before the date of auditor's report that require adjustment or disclosure. Tell me which will require adjustment. Adjusting event which will require only disclosure. Non-adjusting material is appropriately done. What do you have to see? Obtain sufficient and appropriate evidence that all the events which require adjustment are adjusted, or which are material only require disclosure are disclosed. Okay. 2. Respond appropriately to facts that come known to the auditor after the date of auditor's report. If we come to know of anything after the date of auditor's report, had we known before, we would have changed the report. How to deal with that? Okay. Second, forget as of now. As of now, you consider we have only one thing in this standard, that is all events occurring after balance sheet date, before date of auditor's report here. Okay. 31st March and signing date by partner is 20th June. All events in between that. Let us consider only this much. Okay. Come here. So first question what they can ask is, what are audit procedure regarding subsequent event? What are audit procedure regarding events occurring after the balance sheet date but before the date of auditor's report? Okay, very simple. First question, what are audit procedure regarding events occurring after the balance sheet date before the date of auditor's report? 4 points are there. Number 1, obtain understanding from management. Do you have any procedure for identifying subsequent event? Ask the management of TCS, sir, do you have any procedure for subsequent event? What they will reply, sir, we have 2 girls, okay, one is Kamna, one is Shefali. These both girls identify subsequent event in a diary. Okay, so this procedure we have. Number 1, obtain understanding from management. Do you have any procedure to identify subsequent event? Number 2, okay, if they tell we have this procedure, ask them, have you identified any subsequent event for the current year and how it is adjusted? Please show. See, inquire with management where appropriate TCWG whether any subsequent event are identified which will materially affect the financial statement. Okay, has any subsequent, you are saying this Kamna and Shefali are there, have they identified any subsequent event till now? Third, read the minutes of meeting of, okay, owner TCWG after the balance sheet date. Read the minutes of meeting of owner TCWG after the balance sheet date and inquire about the matter for which minutes are not available. Okay, any minutes not available, ask them, can this become subsequent event? Okay, ask about the matter for which minutes are not available. Fourth and last, read the entity's latest interim financial statement. Many things you will come to know in Q1 report. You know, every quarter listed company have to report. So read Q1 report. Okay. Audit report is of course signed later in July, August. Q1 report is from 1st April to 30th June. Read the entity's latest interim financial statement and see any things which require adjustment or disclosure. In that it is shown that a bad debts loss is booked. You tell them, sir, we knew about this condition in balance sheet only. You have booked in first quarter, wrong. It should be booked last year only because it is giving you further evidence of condition existing on balance sheet date. Number 2, any case, sir, this case was going on balance sheet date. How dare you show in Q1? Okay, please show it last year only. And you're like, okay, sir, we will do it. Okay, read the entity's latest interim financial statement report, Q1 report, and see anything which require adjustment that is made in the financial statement. Very simple. First question, if it comes, super simple. What are audit procedure regarding subsequent event? 4 point. Number one, obtain understanding from management whether they have any procedure for subsequent event. Point number two, inquire with management where appropriate TCWG whether any subsequent events are identified by you. Third, read the minutes of owner TCWG after the date of the balance sheet and inquire about matter for which minutes are not available. Last, read the entity's latest interim financial statement and see any matter that require adjustment or disclosure is appropriately done in the financial statement. Very simple. You have you have to learn at any cost what are audit procedure regarding subsequent event. Very simple. Number one, see, you want to know subsequent event by doing audit. Number one, inquire with management where appropriate TCWG whether you have any procedure for identifying subsequent event. Okay, they say that we have these two girls who will identify subsequent event. Point number two, inquire with management where appropriate TCWG whether any subsequent event are identified. You are saying this procedure is there, agreed, but have you identified any subsequent event till now or not? Okay. Third. Read the minutes of the meeting. Crucial things are discussed. From there, you can know subsequent event. Read the minutes of the meeting of owner and TCWG after the balance sheet date. And inquire about the matter for which minutes are not available. Last, read the entity's latest interim financial statement report and see anything which require adjustment or disclosure that is properly done or not. Small break. 40 seconds, learn nice, not 40, 20 seconds, learn nicely. Done. 1, 2, 3, 4, 5, 6. What are audit procedure regarding events occurring after balance sheet date, before date of auditor's report? Number one, inquire from management and TCWG whether they have any procedure for subsequent event. If they tell this procedure is there, inquire with management and TCWG whether they have identified any subsequent event and how they are adjusted. Okay. Third, read the minutes of the meeting of owner TCWG after the date of balance sheet and inquire about matter for which minutes are not available. Fourth, read the entity's latest interim financial statement and see any matter that require adjustment or disclosure it is properly done. I hope it's easy. Now come to the second part. Facts which come known to the auditor after a date of auditor's report. What if we come to know certain thing after date of auditor's report? Had we known before, we would have changed the report. Okay, here basically two things are there. Come here. See, facts which come known to the auditor after the date of auditor's report, but before the report is published, okay, before the report is given to shareholder, or facts which come known to the auditor after it is given to shareholder. One more time, two situations are there. Facts which come known to the auditor after date of auditor's report. Report is already prepared, but it is not circulated to shareholder. Usually after 15 days it is circulated. So 20th June to 15th July. 20th June to 15th July. Okay. Or things which come known to the auditor after the report is given. After the report is given to all the members. Okay. So after 15th July, if we come to know about anything, what to do? One last time. Okay. Things which we come to know after the date of auditor's report, but before the report is circulated to member, or things we come to know after the report is circulated to member. Had we known it before, we would have amended the report. So two situations. Number one, last time I am saying all the things which we come to know after the date of auditor's report, but before the report is circulated to the members. Okay, so this we have to see before circulated, but had we known before, we would have changed the report. Two, all the things which we come to know after the report is circulated to member, after circulated. Had we known before, we would have changed the report. What to do? Okay, start. Facts which come known to the auditor after date of auditor's report, but before the report is circulated to members. Okay, but had we known before, we would have changed the report. Number one, let's take an example. Okay, Patanjali audit you are doing, Baba Ramdev Patanjali. Suddenly you come to know that, okay, audit report is signed. You are enjoying in Goa, 5-star hostel, hospital. Sorry, what hostel? A 5-star hotel you are there. enjoying with friends, okay, Goa, okay. As soon as you are enjoying there, suddenly newspaper comes, okay. Patanjali is not given relief by court. All the medicines of Patanjali are false, okay. They are saying it is Ayurvedic, but even fever is not cured. Forget about corona with this medicine, okay. So inventory is valued at cost or NRV, whichever is lower. Everyone knows AS2, but here NRV of medicine is zero. Why? Because it will not be used anywhere. And Baba Ramdev had 200 crore of inventory. So 200 crore of loss you have to book. Why? Because this stock is of no use. This medicine he had told will be working for COVID, but it will no longer work. What will do? Now we have to evaluate cost for NRV. NRV is zero net realizable value because court has said these medicines are unconstitutional. Very, very simple. Tell me what to do, what to do, what to do, what to do. Very simple. Facts which come known to the auditor after the date of auditor's report, but before circulated to member. Okay. Number one, discuss the matter with management. As soon as news is there, hello, Baba Ramdev, what to do? I am also seeing on TV, sir. You tell what to do. Discuss the matter with management. See whether financial statement needs amendment. Are you going to change the financial statement? Inquire how management will address this in financial statement. Okay. They are saying, sir, whatever you do, we will tell. Okay. For example, if you want that we should book the loss, we will book it. Okay. Very simple. As soon as you come to know of any such thing, discuss the matter with management. See whether financial statement needs amendment. Do we need to change? Third, inquire with management how they will address this in financial statement. If they change, then two parts. If the management amends the financial statement, auditor will perform the audit procedure on new financial statement and give new report. Very simple. Auditor will do audit procedure on. Okay. New financial statement, we will do audit procedure on new financial statement, give new audit report, game over. Very simple. Come here. But they are saying we are not changing entire financial statement. We are only changing to the extent of subsequent event. Okay. We are saying original financial statement same. Only to the extent of subsequent event we are checking. Okay. Changing, sorry. Then we will amend the auditor's report to include extra date. You will add one more date in auditor's report. That, okay, in this date, between this date and between this date, new date, we have only checked subsequent event. Okay. If the amendment is made only to the extent of subsequent event, then amend the auditor's report to include extra date, that is dual auditor report. In that extra date, what you will write? We have only checked subsequent event, rest was already checked. Okay. Or some people don't write dual date audit report. It will spoil auditor's reputation. They will feel shareholder will be confused. Provide new auditor's report, but write their EOM paragraph, emphasis of matter paragraph, that indicates that we have performed work on subsequent event. Okay. Provide new auditor's report. Okay. Or second way, if you don't want dual dated, you provide new auditor's report, but in that new write in emphasis of matter paragraph, which we will learn in next chapter. Emphasis of matter paragraph, what you will write? That we have done work on subsequent event. Okay. In emphasis of matter paragraph, right, we have specially worked on this subsequent event. Rest report is same, but we have worked on this subsequent event. I hope it is easy. Okay. But last time, if you want, we can do. As soon as you come to know of anything, had you known it before, you would have changed your audit report. Number one, discuss the matter with management. Two, see whether financial statement needs amendment. Inquire how management will address this in financial statement. If management changes financial statement, okay, you will do the audit procedure on the new financial statement and issue new report. You will do audit procedure on new financial statement and issue new audit report. But if amendment is made only to the extent of subsequent event, they are not changing full financial statement, only changing subsequent event, then what shall I do? Very simple. Come here. Amend the auditor's report to include extra date. Amend the report to include one more date. Restricted to that amendment. Make a new report and only write one extra date. Nothing else to do. Amend the report to include one extra date. Okay. Restricted to that amendment. Or provide new report with EOM or OM. Okay. Emphasis of matter paragraph or new matter paragraph that tell us. Emphasis of matter paragraph will tell us what? We have done work on subsequent event. One last time, if they change financial statement, do new audit procedures on the financial statement, issue new report. But if change is only to the extent of subsequent event, change is only, then what we'll do? Provide dual dated audit report. Provide an audit report with an extra date that between this date and this date, we have only checked subsequent event. Or provide new auditor's report with EOM paragraph, emphasis of matter, about which we will learn in the next standard, next chapter, emphasis of matter paragraph that we have checked subsequent event. Understood? Either ways, it's okay. Come here. If management does not change financial statement, they are saying we will not change. What we will do? Inform management not to issue report. Management, if you are not changing, don't issue report because you are misleading shareholder. If they still issue, okay, we will take action to prevent reliance on a report. What action we will take? We will issue public notice that management did not listen to us. Okay, we will issue public notice in newspaper. Don't rely on the report. Don't rely on the report. It is not our report. Number one, if management, see, audit report is signed by us, but it's not issued to member, we will tell don't issue. Inform management not to issue. If they still issue, take legal action to prevent reliance on report. You can give a public notice, don't rely on this report, don't rely on this report, there could be changes, no need to write more. Understood? Come here. Sir, oh sir, what if I come to know after the report is issued to member? Had I known before, I would have changed the report. After the report is issued, first line in both you have to write one thing. Usually there is no obligation for anything which happens after the report is issued to member. But had I known it before, we would have amended the report. Then again same 3 point. Discuss the matter with management. See, financial statement needs amendment. Inquire how management will address this in financial statement. If they change financial statement after the report is issued to member, still changing the financial statement, I will issue new audit report. I will issue new audit report. If they don't change, they are saying will not change, it's already circulated. Ensure every recipient is informed about the change. Whoever has got financial statement is informed through a letter that this change has happened. Inventory should be down valued by 200 crore. Ensure every recipient is informed. If they don't inform, take legal action to prevent reliance on report. You can give a public notice. Don't rely on report. Understood? Okay. What if after it is circulated? First line what you write? Okay. Usually auditor has no obligation to do anything after the report is circulated to member. But had he known before, he would have amended the report. Then, number one, okay, inquire with management how they will address this in the financial statement. Same 3 point. Discuss the matter with management. See, financial statement needs amendment. Inquire how management will address this in financial statement. If they change, we will issue new auditor report. What if they don't change? So if they don't change, then ensure that every recipient is informed about the change. Tell them you are not changing, inform everyone about the change. If they don't inform, then what to do? Take legal action to prevent reliance on the report. Okay. So your 3 situations are there. Wonderful essay, tricky essay, but I have explained in the best way. Number one, events occurring after balance sheet date but before date of auditor's report. After auditor report but before circulated to member. Okay, after date of auditor's report but after the report is circulated to the member. I hope it is clear. Come here, one more essay is there, very interesting, very mind blowing. That's auditor and going concern assumption. Okay, auditor and going concern. How do we remember? See, management, WR from management is 580. After 5, what will come? 6 will come. After balance sheet, subsequent event, 560. If you don't do after 5, 6, 5, after 5 directly 7 will happen. Auditor and going concern assumption. Auditor and going concern assumption. Auditor and going concern assumption. Very nice essay, very amazing essay. Concentrate here. First, little basic knowledge is required. See here. 1, 2, 3, start. Basic thing, okay? Before starting this essay, going concern is always, see, one day everything will be closed, okay? First of all, why going concern is a big thing in life that you need to understand. What is going concern? Business will continue for unlimited years. But someday every business is going to get closed, be it Reliance, be it Tata, be it any damn business, TCS, okay? They are going to get closed. But what's the problem if they get closed? Means going concern is not valid. Okay, and whenever going concern is not valid, assets and liabilities are valued on liquidation basis, that is net realizable value. They are no longer valued at cost. Why? Because going concern is not valid. Very simple. Okay, understand. Going concern is the most important essay, because whenever going concern is not valid, okay, you need to tell shareholder company is getting closed so they can get their funds back. Okay, they can take the action. They should know in between or before, well in advance. That is what is the work of auditor. This all brief background I am giving. Now tell me, when can I say there is doubt on going concern? You will say, sir, company is in loss. Paytm is in loss since years. Can we say going concern affected? No. Okay, Zomato was in loss since years. Can we say going concern affected? No. Amazon was in loss for 17 long years. Can we say going concern affected? No. Okay, we have to. Now listen, now I am starting the essay. We have to check going concern for foreseeable future. Now your next question will be, what is foreseeable future? 12 months from balance sheet date. Any company audit you do, you have to see on balance sheet date. Will it work for 12 months? Answer is 2. Either yes or no. If it is a yes, don't do anything. Okay, going concern is valid. If it doesn't work for 12 months also, then we will do something. A going concern is always checked for foreseeable future. What is foreseeable future? 12 months from balance sheet date. So anytime, remember, you go to do audit of any damn company, just check one thing. Company will work for 12 months or no from balance sheet date. If answer is yes, going concern is valid. Don't do anything. In 99.99% case, going concern is valid. But if it doesn't work for 12 months also, then we will say going concern is invalid or material uncertainty exists. Either of the two options which we'll study. Come here. When going concern is not valid, okay, assets and liabilities are shown on liquidation basis. That is the big thing. We need to tell shareholders the true worth of company. Come here. So when will I have doubt? Whenever there are indicators. See, there are financial, operating, other. Whenever you find there are indicators, okay, there can be a doubt on going concern. So number one, while doing audit, certain indicators are given by standard. Financial, operating, other. Let me name one. Okay, what's financial? Adverse ratio. Current ratio is adverse. You don't have money to pay. Okay, negative operating cash flow. Financial. What's operating? Loss of raw material. Okay, loss of major customer. Lot of competition is there. Other legal cases are there on company. If there are indicators, then what will check? Mitigating factors. Okay, we will check mitigating factors. Come here. Whenever indicators exist, we will check mitigating factors. Okay, what is mitigating factors? Does management have a good plan? Okay, we feel going concern is not valid, but is the plan strong enough? Whenever there are indicators, we will do additional procedure, that is check the mitigating factor. After checking, 3 conclusion can come. Going concern is valid, don't do anything. Going concern is invalid, of course assets and liabilities have to be shown at net realizable value. Last, going concern is valid, but material uncertainty exists. See, sometimes what happens? You are in love. Sometimes you are not in love. Sometimes it's complicated. So this is that complicated third one. Going concern is valid. Okay, we feel company will work for 12 months, but there is little doubt. Little, but we cannot say it's invalid. We cannot say it's invalid. It doesn't mean I don't love him. But I don't love him that way. Understood, sir. Fully understood. Going concern valid. I love you. Going concern invalid. Oh, I thought you are my brother, baby. Okay, you are thinking I love you. Are you mad? Look at yourself. Look at me. Invalid. Okay, going concern is valid, but material uncertainty exists. It's valid, but there's a little doubt. There's a little doubt. So after checking mitigating factors, 3 things will come. Going concern valid, going concern invalid, going concern valid, but it's complicated. Material uncertainty is there. I hope you understood this much. If not, you will still understand. Be rest assured. Come here. Now I am starting the standard. This was a background. Auditor has to obtain sufficient and appropriate evidence regarding going concern. However, there are limitations on going concern. Why? Because it's for future. Who can predict future? You are saying going concern is valid. Doesn't mean it will be valid. What if COVID comes again? Okay. People again, Jet Airways. You look at Jet Airways. Who would have thought Jet would be closed? Who would have thought Indian cricket team sponsor Sahara would be closed? Who would have thought Satyam, top 3 company, would be closed? Okay. So if we don't say anything about going concern, doesn't mean going concern is valid, because no one can predict the future. Auditor cannot predict future condition. So absence of anything about going concern cannot be a guarantee that going concern is valid. As of now, it's valid, but anything can happen. There is an inherent limitation in going concern because future is in no one's hand. Are you clear? Okay. So tell me, when can doubt come? When there are indicators. How many indicators are there? Three: financial, operating, other. Come here. What is financial indicator? Net liability or net current liability. When liability is greater than asset, it's an indicator. Negative operating cash flows are negative. Fixed term borrowing approaching maturity without realistic chance of repayment. Fixed term borrowings are there. You have to repay EMI, interest, principal. You don't have money. Indication of financial support by creditor. Creditor are not giving you goods on credit. Okay. Adverse current ratio, adverse quick ratio, adverse super quick ratio. Are you clear? So very simple. Tell me, what are financial? Net liability, net current liability. Negative operating cash flow, withdrawal of financial support by creditor. Okay. Fixed term borrowing approaching maturity without realistic chance of payment. Adverse key ratios. I hope you understood. I hope you understood. I hope you understood. Okay. One last time. Net liability or net current liability. You don't have to learn. Roughly also you can learn. Net liability, net current liability. Adverse ratios. Negative operating cash flow. Fixed term borrowing approaching maturity without realistic chance of payment. What are operating indicator? Here remember three words: raw material, work in progress, finished good, customer. Raw material, work in progress, finished good, customer. Raw material point will be what? You only tell me. Okay. Raw material point is very simple. Okay. Withdrawal of major supplier, loss of major supplier. Who was supplying material is no longer there. Of course, going concern affected. Okay. Loss of major supplier. Okay, there is lot of competition. Okay, in WIP, what we'll say, labor difficulties are there, so we are not able to produce. Okay, finished good, loss of major customer, loss of major customer. There is lot of competition. Anything you can write. Okay, see here, management intention to liquidate entity, loss of key management, loss of major market supplier, labor difficulty. Okay, highly successful competitor, loss of major customer. Very simple. Okay, see, if you want to remember, again same: raw material, work in progress, finished good. Raw material, loss of major supplier. Okay, labor difficulty, you cannot produce only work in progress, you cannot produce only work in progress. Okay, now come to FG, finished good, loss of major customer. Okay, your major customer is no longer there, loss of major customer, labor difficulties are there. Okay, management intention to liquidate the entity. Okay, emergence of highly successful competitor. Very simple. What are other indicator? Tell me. Okay, lot of cases are there on company. If those cases have become true, we will lose the case and company will be closed. Okay, non-compliance with capital adequacy or other ratios. In banks, usually they have to maintain ratio. Non-compliance with capital, regulatory, other ratio. Pending legal cases, if successful, pending legal case, if successful, we cannot satisfy. Changes in law, regulation. Okay, we have gaming business, government has increased GST on gaming, our business will be closed. Plastic business, plastic is going to be banned by government in future. Okay, we have liquor business in Bihar, it is banned in Bihar, liquor, we are gone. Changes in law. Uninsured or underinsured catastrophe if they occur. What is catastrophe? Major disaster. Any disaster, we have not done insurance, or insurance is of 10 lakh but building value 2 crore. Okay, so if catastrophe will occur, we will go. What is catastrophe? Major disaster. Simple. So tell me, what are other indicators? Non-compliance with capital adequacy, other ratios. Okay. Uninsured, underinsured catastrophe. Pending legal cases. Changes in government laws, rules, regulations. Simple. Okay. Tell me other indicator. Okay. Lot of pending legal cases. If they happen, company will close down. Okay. Changes in law, regulation or government policy. Okay. Uninsured or underinsured catastrophe. Catastrophe means major disaster. So whenever there are these indicators, three: financial, operating, other, financial, operating, other, we will check mitigating factors. Okay, come here. These additional procedures are done only when there are indicators. One last time, these additional procedures are done only when there are indicators. Whenever there are indicators, we will do additional procedure. Come here. Auditor shall perform the following procedure. Okay. Tell me additional procedures. When are these done? Additional procedures are done when events or conditions are identified. Whenever there are event, whenever there is a condition, we will do additional procedure. Auditor shall perform additional procedure only when events or conditions are there. Number one, when management has not yet made an assessment, tell management to make an assessment of going concern. Okay, that time we will call management. Management, please make going concern assessment. They will tell what? Sir, going concern valid only. Why are you worrying? Okay, or you only make assessment. Sir, in our standard it is written you have to make assessment. I cannot make assessment. It's your company. You live 365 days in this company. Okay, how can I make your assessment? Okay, our standard is told management will make assessment. Okay, when management has not yet made assessment, tell management to make assessment. After they make, they will give you report. Sir, oh sir, oh sir, this is the report. Sir, this is the report. See, going concern report. I will tell, okay, understood. Evaluate the management plan for future action in relation to going concern. Do you feel it will be valid? Okay, in this much competition, management plan is feasible. Evaluate the future plan of management in relation to going concern. In that plan, what is there? Cash flow is there. See the assumptions used in the cash flow. At what rate they will grow. Okay, third point is what? Where entity has prepared cash flow forecast. See the assumptions used in forecast are reasonable or not. Okay, 4. Okay, call again management. Management, is there any additional facts or situations that are available since the time you made assessment? You made assessment before 10 days. In 10 days, have you seen any other change? Consider any additional facts or information that are available since management has made assessment. Last point, okay. If you feel plan is good, request WR from management, written representation from management regarding the plan and future feasibility of the plan. Regarding future plan and feasibility of the plan. Understood? 100% you have to remember this. Okay, we will try our best. Okay, tell me, when are these procedures done? Whenever there are financial operating other indicator, we have to check, is there a additional procedure we have to do? Is there a strong mitigating plan? Point number one, where management has not yet made assessment, tell them please make assessment of going concern. They will say you make, we will tell no, you have to make. Okay, number one, when management has not yet made assessment, tell management to make a assessment. Evaluate the management plan for future action in relation to going concern. Check the plan is good or not. Okay, in relation to going concern. Third, okay, in plan what is there? When entity has prepared cash flow forecast, see assumptions in the forecast. Okay. Fourth, consider whether additional facts or situations are available since the time management has made assessment. Consider any additional facts, additional situations are available. Okay, additional facts or information are available since the time management has made assessment. Last, request WR from management, written representation from management regarding the plans and regarding feasibility of the plan and future plan. Regarding future plan and feasibility of the plan. Very simple. We have to learn anyhow. Last time I am speaking. Very simple. Imagine you are auditor, only then you can learn. If you try to learn, not possible. Okay. Number one, when management has not yet made assessment, additional procedure, tell them please make assessment. Then they will give you assessment. Okay. Evaluate the management plan for future action in relation to going concern. Is the plan good or not? You have to see. Inside plan, what is there? Cash flow forecast, where management has prepared cash flow forecast. See the assumptions used in the forecast are appropriate. Okay, then okay, ask management, is there any additional conditions or information that are available since the time management has made assessment? In this 10 days, has the plan changed? Okay, additional facts or information is available. Last, okay, request written representation from management regarding future plan and feasibility of the plan. Okay, request WR from management regarding future plan and feasibility of the plan. Learn nicely. Small break, 30 seconds. Done. Chalo, 1, 2, 3, 4. Come on, number 1. Whenever there are indicators, we will check mitigating factor. Whenever there are indicators, we will check mitigating factor. In that, what we will check? 5 point. Where management has not yet made additional procedures to be done. When indicators are there. So, what are additional procedure? 5. Number 1. When management has not yet made assessment, tell management to make a assessment. 2. Evaluate the management plan in relation to the future, in relation to going concern. See whether the plan is feasible or not. What is there in the plan? Okay, cash flow. Where management has prepared cash flow forecast. See assumptions used in the forecast. Fourth point, okay, see whether any additional facts or information is available since the time management has made the assessment. Okay, last, request written representation from management regarding future plan and feasibility of the plan. Regarding future plan and feasibility. After that, after checking this entire plan, 3 conclusion can come. Number 1, going concern is valid. Okay, number 1, you feel everything is perfect, plan is super perfect, I think they will be fine. 2, you might feel that plan is third class, nothing is good in the plan, absolutely horrible, company is going to fail, going concern invalid. Or you might feel it's valid, but still I have my own concerns. I cannot say it's invalid. I cannot say that it will close down, but I cannot say it is good also. In between, it's complicated. Going concern is valid, but material uncertainty exists. What material uncertainty exists? Clear? Okay. Come here now. Last slide. Okay. Number 1, going concern is not valid. Going concern is not valid according to you. Okay. So number 1, okay, if management has prepared financial statement, if it's invalid, you have to show assets and liabilities at NRV. If management has prepared financial statement on NRV basis, liquidation basis only, we will give unmodified opinion, clean opinion. Why? Because they have given whatever was required. You had to prepare financial statements on NRV. They prepared on NRV only. We will give unmodified opinion, but in emphasis of matter paragraph, which will come in next chapter, we will write we have followed alternate method of accounting. Usually financial statements are valued at cost, but we have valued them at NRV. Come here. Okay, we will write in EOM paragraph that we have followed alternative method of accounting. Come here, come here, come here. Management has said we will not change financial statement. We will still show them at cost only. If management has prepared financial statement as per the going concern is valid, but actually going concern is not valid, they have prepared on cost, then what we'll do? We will give adverse report because everything is wrong. Assets, liability, income, expense, everything is wrong. Okay, because it will affect all accounts. Very simple. Okay. Last time, if you want, we can speak. If going concern is not valid, but management has prepared financial statement on liquidation basis, give unmodified opinion, but in emphasis of matter paragraph, right, emphasize that alternate method of accounting is followed. But okay, if it's invalid, but they have still shown or prepared financial statements at cost, which is wrong, then which will give? We will give an adverse report because assets, liabilities, everything is wrong. I hope it's clear. Come here, come here, come here. Going concern is valid, but there is material uncertainty. Going concern valid, but there is what? Material uncertainty. If adequate disclosure about material uncertainty is made in financial statement, they will write in financial statement that material uncertainty is there. We will give unqualified opinion, but in auditor's report, what we will write? Separate heading we will write under going concern. Material uncertainty is there relating to going concern. Okay. So if going concern is valid, but there's material uncertainty, if they write in financial statements, see, this financial statement will be valued at cost. But if they write in financial statement that material uncertainty is there, it's written in notes to accounts, then what will give? Unqualified report. But in auditor's report, we will write under going concern valid, but material uncertainty exists. But what if they don't write in notes to accounts? If the disclosure is not made in the financial statement, if they don't write about material, they are like, no, 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 shareholder will feel bad, shareholder will not invest in my company, I will not write all this. Then I will give qualified or adverse opinion, qualified or adverse. If I feel little it will be affected, then qualified. If I feel that everything is affected, then adverse report. In basis of opinion, I will write material uncertainty exists, but same is not disclosed in financial statement. There is a doubt about going concern, but they have not written the same. Clear? Last time, if valid to no tension, if valid then to they will write only valid. Okay, if going concern is valid but material uncertainty exists, if they write in notes to accounts, no problem, unqualified report, but I will write in my auditor's report separate heading, material uncertainty is there relating to going concern. Understood? Come here, come here, come here, come here, come here. If adequate disclosure is not made in financial statement, no disclosure is made, auditor shall express qualified or adverse report. If they don't write in notes to accounts about material uncertainty, I will give qualified or adverse report. In basis of opinion, I will write. Why have I given qualified or adverse? In basis of opinion, because material uncertainty is there and same is not written in notes to accounts. Clear? I hope it's clear. So two complicated standards are done. Now we have new standards, brand new 3 standards, but all 3 are very easy. Okay. So one more time. Till now we are done with 3 standard. SA 580 written representation from management. SA 560 after 56 will come balance sheet event. SA 570 going concern. Okay, so now how to remember all 3 in one go? After 56 will come after balance sheet subsequent event. If you don't do after 56, okay, your after 57 will happen going concern. Your going concern will be in doubt. SA 570. Whenever going concern is in doubt, you have to take WR from management. SA 580. How to remember? After balance sheet, what will come? After 56 will come subsequent event. Okay. But if you don't show subsequent event and do lot of fraud, SA 570 going concern will be in doubt. Whenever going concern is in doubt, you have to take WR from management, written representation from management, SA 580. Come here. 3 new standards, but all 3 very easy. 5 minute standard, super easy. Concentrate. Significance of communication with those charged with governance. This standard purely tells us why auditor needs to communicate with those charged with governance. What's the meaning of communication? Why should you communicate at all with TCWG? Okay. First of all, understand thing number 1. Who is those charged with governance? Every company has their own management. Tata Steel, Tata Motor, okay, TCS, Tetley, okay, Taj Hotels, okay. Then we have what? Tata Salt, we have Tata Communication, Tata Consumer. Every company has their own management. But people who give direction above management, there are certain non-executive, non-independent directors. Okay, there are certain top level people who give direction to the company, who set the vision, the mission, who oversee the financial reporting process. Above management, there are certain people who manage all companies. They give direction to the company. They are responsible for financial reporting. They communicate with auditor. They are in a trust type of position. They will ensure nothing wrong happens to shareholder. Management doesn't misuse company for their own benefit. Okay, the shareholders' interest is protected. Those are those charged with governance. They are above the management. They are responsible for financial reporting process. Nothing wrong should happen. Auditors' interest should be protected. Shareholders' interest should be protected. Usually we have independent directors there. So. Okay. Directors or management doesn't misuse their power, doesn't abuse the office of power. Understood? Okay. So now, why should you communicate significance? See, what's the meaning of SA 260? Significance of communication with those charged with governance. Okay. Basically here in this standard, 2-3 words. Okay. Why is this standard there first of all? Okay. Number 1. It will tell what all you need to tell to those charged with governance. What are responsibilities of auditor? What are responsibilities of those charged with governance? Why it is important to communicate with those charged with governance? Okay, so there is transparency. So there is a trust between both. So audit can be done in a nicer way. Okay, so this basically is not a Average standard. This basically tells that why should you communicate with those charged with governance, or how to communicate with those charged with governance, what to talk to them, what not to talk to them. Why? So there is clear picture. Roles of auditor are clear. Roles of those charged with governance are clear. Okay, very simple. I will just read time pass standard. It is communicate clearly with those charged with governance. Responsibilities of auditor. We will tell those charged with governance, these are our responsibility, these are your responsibility. Obtain. Why is this standard there? So we can obtain from those charged with governance information relevant to audit. What you have to obtain. To communicate with those charged with governance, what are their roles and responsibility for financial reporting process? Sir, these things you have to do. Okay. If this standard is there, it will promote two-way communication between auditor and those charged with governance. If communication is good, there will be better trust. Okay, if better trust is there, audit can be done in nicer way. Nothing good till here. Only one question can come from here. This is this. Why should you communicate with TCWG? More than why? What will you communicate? Matters to be communicated to those charged with governance. Four matter. Number one, plan, scope, and timing of audit. What do you mean by scope? These things I will check. I will check everything relevant to financial statement. I am not concerned with production, marketing, HR. I am only concerned with financial statement. So number one, what I will tell to them, okay, matters to be communicated to those charged with governance. Number one, plan, scope, and timing of audit. This is our scope of audit. We will check these things. Timing. This is when we will give you report. Okay. These are the dates when audit report will be ready. If it's a quarterly audit, every 3 months we will do the audit. So number one, what will you tell with them? Plan, scope, and timing of audit, including communicating significant risk in the entity. This, you remember, always 4 are significant risk we have learned. Okay. Related party, fraud, non-routine, judgmental. Related party, fraud, non-routine, judgmental. If you remember, judgmental matters. Second, independence requirement. In case of listed companies, we have to tell them we and our team are independent. We are nowhere related to the company. So audit will be done in unbiased way. Okay. We will communicate whether partner, team, and all our network firms. You know what's network firm? Okay. Many times we have 10 firms under me. All these are also independent. They have also not purchased shares of company. Like Ernst & Young, I used to work there. We had 10 associate company, SR Bartley Boy, SV Ghatalia and company, etc. Me, my team, and network firm are independent. And if there are any threats to independence, they are removed. If there are any threats to independence, we have removed them. Means there is no threat to independence. So in case of listed company, we need to tell them we are independent. 3 people, partner, firm, and network firms are independent. If there is any threat, if anyone had shares of company, we have sold the shares. Okay, we have sold the shares. Okay, if any threat exists, we have safeguards to eliminate them. This thing should be in writing. Okay, independence requirement you need to give in writing to those charged with governance. Fourth, they will tell you only prepare financial statement. We will clearly tell them, sir, our responsibility is to give an opinion on the financial statement, not prepare. Like mom will prepare the food, my work is to eat the food. Same way, my opinion is to give. My responsibility is to form an opinion, not prepare financial statement. That is the work of your management, sir. Please tell your management. Responsibility is to form an opinion. Clearly tell them our responsibility is to give an opinion. Okay. Fourth, what you will tell to them? Tell me why to tell. So there is more transparency. Roles are clear. Communication is better. See, the only work of this standard is what to tell to those charged with governance. Why to tell to them? So roles are clear, responsibility are clear, transparency is there, work is done in better way. Now last what will tell? Significant findings from audit. In there 5 points are there. Significant qualitative aspect of clients accounting policies, practices, and estimate. Qualitative aspect means why this accounting policy is followed, okay, or why this policy could be better. Example, many times we will book sales, okay, whenever order is received, we will tell them this is a wrong policy. We should book the sale when delivery is done. Significant qualitative aspect of clients' accounting policies, practices, and estimate. Usually, we should never book sale when order is received because there are sales return also. Then you have to do a lot of sales return. Always book when it is delivered or when goods go out of. That we'll discuss, of course, when goods go out of go down. Second, significant difficulties found during audit. Okay, significant matters that were discussed with the management, this we can tell to them. Any other significant matter that in auditor's judgment are necessary for the oversight of financial reporting process. I think I should tell you all these things. Okay, here, oversight in financial reporting process. There is no proper process. You don't have any qualified charter accountant, such things. Okay, any other matter which you feel is necessary. Oversight means taking care of financial reporting process. If you feel anything, you can tell them. Circumstances which may change the form and content of report. See, whenever there is adverse report, disclaimer report, form and content of report will change. That is, form means format, content means what is inside the report will change. Okay, whenever there is qualified, disclaimer or adverse report, this also we will tell to them. Tell me what we will tell in significant findings. 5 points. Try to remember. If you can, you are amazing. Significant qualitative aspect of clients' accounting policies, practices, estimate. Okay. Significant difficulties encountered during audit. Significant matters that were discussed with management. Any other significant matter that in auditor's judgment is necessary for oversight of financial reporting process. Last, circumstances that will change form and content of auditor's report. Clear? Try to remember if you can. Significant findings from audit last time. Significant qualitative aspect of client accounting policy, practices, estimate. Significant difficulties encountered during audit. Okay, significant matters during audit that were discussed with management. Any other significant matter that in auditor's judgment is relevant for financial reporting process. Okay, that is necessary for oversight of financial reporting process. And last point, circumstances that will change form and content of auditor's report. Learn nicely. Your time starts now. Try learning, because only this one question can come, nothing else can come. This standard is of 5 minutes. Okay, one, two, three. Significant findings from audit. What you will write there? Significant qualitative aspect of client's accounting policy, practices, estimate. Significant difficulties encountered during audit. Any other significant matters that were discussed with management. Any other significant matter that in auditor's judgment is necessary for oversight of financial reporting process. Circumstances which will change form and content of auditor's report. Come here. So 4 things I will tell to TCWG. Very good. How many things? 4. Sirf itna sa ख्वाब hai. There is one song. You just have to remember sirf. Sirf means only this much. Sirf. S. Plan, scope and timing of audit. I. Independence requirement. R. Our responsibility is to form an opinion on financial statement. F. Significant findings from audit. Significant findings from audit. Tell me, what will I tell to TCWG? 4 things. Sirf. Plan, scope and timing of audit. I. Independence requirement. R. Our responsibility is to form an opinion on the financial statement. F. Significant findings from audit. Tell me, what will I tell to TC? Very simple. Communication. Significance of communication with TCWG. First question. What auditor will communicate with those charged with governance? Independent directors. What will you tell them? Sirf. Number 1. Plan, scope and timing of audit. In that I will tell all the significant risk. Okay. I. Independence requirement. R. Our responsibility is to form an opinion on the financial statement. F. Significant findings from audit. Learn nicely. Small break, 10 seconds. Clear? 1, 2, 3, start. Tell me, what will I tell to TCWG? Sirf. Plan, scope and timing of audit. I. Independence requirement. R. Our responsibility is to form an opinion on the financial statement. Significant findings from audit. Come here. Auditor shall communicate with TCWG general expected timing and content of communication two things I will communicate in writing. Remember, number one, independence requirement, bracket, listed company. In listed company, independence is very, very important, and significant findings from audit. Significant findings from audit. These two things in writing. Other things I can discuss orally, but I have to maintain documentation. I have to maintain documentation that I have discussed orally. Whenever you discuss, same day you have to write that we had discussed these things. Okay, but two things compulsory in writing: significant findings from audit and independence requirement listed company. Tell me, what if they don't talk to you? They are saying, what we will talk. You are saying, TCWG, please come here. We want to discuss SIRF, plant scope and timing of audit, independence requirement. Our responsibility is to form opinion. If they don't talk only then ROMM will be higher. Risk of material misstatement will be higher. You cannot issue qualified report for this, but risk of material misstatement will be higher. You need to gather more evidence. Okay. If communication is not adequate, ROMM will be higher, and we will take appropriate action, maybe gather more evidence. Documentation over. The auditor shall communicate to TCWG orally or in writing. Audit documentation. Okay. We will communicate whatever we have told to TCWG. We have to maintain documentation orally, then write. Written to very simple. Clear? What can come here? What matters we have told to TCWG? Second MCQ can come. What we need to communicate in writing. Rest the thing can come. Only two things confirm in writing: independence requirement and significant findings from audit. I hope it is clear. Super duper clear. Rest assured. Okay. So significance of communication with whom? Those charged with governance. Come to essay 265. Communicating deficiencies in internal control to management and TCWG. Deficiency in internal control, I will tell to two people: management and those charged with governance. Before starting this standard, some basic question will come. Come here. Deficiency and all we will understand. Communicating very easy standard. 265. That was hard, okay, or easy. This is super duper, multiply by 10, easy. What is deficiency? Before understanding all this, I will ask you basic question. Who is responsible for preparing financial statement? Your answer will come: management. Very good. Come to second question. Management will also implement internal control, so there is nothing wrong done in financial statement. Management will implement internal control, so there are no misstatements. Okay, but when internal controls cannot prevent or detect and correct material misstatement, we call it deficiency. One more time: when internal control cannot prevent or detect and correct material misstatement, it's called deficiency. One more time. One last time I want to ask one question. Who is responsible for preparing financial statement? In India, management. But management will do strong control so that there are no mistakes. Okay. We do strong control. But when the controls are not strong enough, when internal control cannot prevent means stop, or detect and correct material misstatement. If mistakes still happen, we will call it deficiency in internal control. Our work is not to identify deficiency, but it's to do audit. But while doing audit, if I find deficiency means what? Control is unable to prevent or detect and correct material misstatement. I will report to management. I will report to management or TCWG. Come here. Auditor's work is not to identify deficiency, but to do audit. But if during audit we find deficiency, we will report. We will report. What is significant deficiency? These are those deficiencies which are of utmost importance in the judgment of auditor. See, now two deficiencies are the normal and significant. What's the difference? See, significant deficiency simply means probability and impact is high. Okay, what do you mean by probability? Chance of that thing happening, impact is the loss. If probability and impact is high, we call it the significant deficiency. Otherwise, it's a normal. See, it's very difficult to differentiate between normal and significant. Okay. For example, you are not studying for 10 days. Is it bad? Yes. Okay, weakness in control. Okay, you are not studying for 5-10 days. It's a normal deficiency. It happens to students. They don't study. Mood is not good. But, what if you leave the house? It's a significant deficiency. Your parents have to find out what happened exactly. Okay, so deficiency The significant deficiencies are those deficiencies whose probability and impact is high, or which are of utmost importance in the judgment of auditor. So if auditor feels this is significant, it's significant. If auditor feels this is normal, it's normal. You as auditor have to decide. It is the judgment of auditor. Those deficiencies which are of utmost importance, they are significant deficiency. Clear? One last time. Till now, I have not explained you anything. I will just want to explain again. Communicating deficiency in internal control. See, who is responsible for preparing financial statement? Management. Question number 2, I want to ask you. Management will also implement internal control, so there are no misstatement. But when controls cannot prevent or detect and correct material misstatement, or even after having control, if wrong things happen, if misstatement happen, we call it deficiency. Two deficiencies are there: normal, significant. If there is a normal deficiency, means probability and impact not that much. Okay, probability means chance of wrong happening, impact means the amount. If it is not that much, normal. If probability and impact is high, significant. Okay, but book has not given. Book has given what? Those deficiencies that in the judgment of auditor are of utmost importance. Utmost importance, then those are significant deficiency. Clear? Read. Auditor is required to obtain understanding of internal control while doing ROMM. You know what's ROMM? Risk of material misstatement. IR into CR. Whenever we find control risk, we will assess controls are strong or weak. If control are weak, that's a deficiency. Okay, so number 1, our work is not to identify deficiencies, but while finding risk of material misstatement, we may find out deficiencies. Okay, objective of auditor is what? Communicate deficiencies in internal control that are of utmost importance. That's significant deficiency. Difference between deficiency and significant deficiency. Deficiency is what? Exists when control is missing or control is unable to prevent or detect and correct material misstatement. What's significant deficiency? Significant deficiencies are those deficiencies that in the judgment of auditor are of utmost importance. That in the judgment of auditor are utmost importance, or whose probability and impact is high. Probability and impact. Let me name a few significant deficiencies. Okay. There are no qualified people in accounts department. They don't have knowledge of accounting standards. They don't have knowledge of financial reporting framework. Okay, there is no proper period and financial reporting process. Okay, there is no financial reporting process to prepare financial statement. All the people are unqualified. Management is not serious about internal controls. Okay, these are significant deficiencies. Everything will be wrong. They don't have knowledge of accounting standards. They are not qualified people. These can be significant deficiency. Few example I told you. How to identify significant deficiency? We shall determine whether there are one or more deficiencies. See, sometimes one deficiency is not there, but when they combine, they can become significant deficiency. We shall identify there are one or more deficiencies in internal control. Based on that, auditor will determine whether individually or in combination, can they become significant deficiency. Understood? See, we shall see whether one or more deficiencies in internal control. Based on that, auditor will determine whether individually or in combination can they become significant deficiency. These are those deficiencies that are of utmost importance in judgment of auditor. If auditor feels it significant, over. Very simple. I will tell to whom? See, significant deficiency, I will tell to both management and those charged with governance. Normal deficiency, I will tell to management. Example, if you don't study for 3 days, mom you will tell. Mom will scold you. But if you leave the home, we need to tell dad also. At that time, only mom is not allowed. Okay, example. You go to birthday party. Okay, deficiency in internal control, your work is to study. But only mom comes to know that you are going during the day. You tell, don't tell to dad, he will scold. No, dad, no. But if you leave the house, it's a significant thing. Mom, dad, family, everything will be told. Even uncle, auntie will be told. Okay, auditor will communicate in writing significant deficiencies in internal control to those charged with governance. See, in writing, I have to write significant deficiency to TCWG. Auditor will communicate with management. Which deficiency? In writing, significant deficiency. To management also I will give, provided it is not the deficiency of management. If management only has done mistake, I will not tell them their own mistake. Okay. Other deficiencies also I will tell to management that require management attention. So remember, normal deficiency management, significant deficiency management, and TCWG. But most important, in writing, in writing. But if it's management deficiency, don't tell to management only. Dad's bad thing, we will not tell to dad, dad, this is bad in you. Dad will say, get out. Are you clear? The last, normal deficiency management, significant deficiency management, and TCWG in writing. Come here. Auditor will give written communication of significant deficiency. Two things we will write: description of deficiency and their effect. Description of deficiency and their effect. And sufficient information to enable the auditor to understand context of communication. One last time, auditor will write written communication of significant deficiency, okay, description of deficiency and their effect. This is the weakness. We don't have qualified people in accounts department. Due to this will happen due to that. A description of deficiency and their possible effect. Sufficient information to enable TCWG to understand context of communication. Sufficient information so those charged with governance can understand what's the context of communication. Clear? Our aim, in the last we will write, our aim is to do audit, not to find out deficiencies. But while doing the audit, while finding risk of material misstatement, we found them. Okay, very simple. So tell me, in significant deficiency, what we will write? Only this question can come. Mostly this is a MCQ. Okay, a description of deficiency and their possible effect. Okay, description of deficiency, their possible effect, and sufficient information to enable TCWG to understand the context, how this deficiency has occurred. Okay, nothing great. Now, last thing we can read here is this. It will make you more proper. See, 265 is what? Okay, communicating to both TCWG and management. 260 is only communicating to TCWG. 265 is only deficiency in internal control. Any other matter I want to tell to TCWG, 260 is there, other than internal control. Your letter of weakness is there. For significant deficiency, I will write description of deficiency, their effect, and sufficient information to enable TCWG to understand the context. Letter of weakness is written. For significant deficiency, 1 mark MCQ. Which letter is there? Letter of weakness. Here no such letter is there. Simple. In one line, concentrate. Whenever I want to talk with TCWG, 260. If I want to talk about deficiency in internal control, 265 TCWG and management. What will I talk in 260? बस सिर्फ planned scope and timing of audit. Independence requirement. Our responsibility is to form an opinion on the financial statement. Significant finding from audit. Here what I will tell, only significant deficiency in writing, okay, through letter of weakness, Here all things except significant deficiency. Very simple. 260, communication with TCWG. 265, communicating deficiencies and internal control to management and TCWG. Last point. Last standard, guys, then we are done. Yeah. 450, evaluation of misstatements identified during the audit. Okay. Last, very easy, very chill, very amazing standard. Okay, this also, all three I told you, very easy. New age standards are there, but they are super easy. Okay, SF 450, evaluation of misstatements identified during audit. For those of you who don't know misstatement, I explained in revision of chapter number 1. Misstatement is difference between CAP, classification, amount, presentation and disclosure of a reported financial statement item, and one more CAP, classification, amount, presentation and disclosure required as per financial reporting framework. What do you mean by this? See, financial statement, this should be the correct treatment, but you have given that. So any mistake is there. Example, I will take 2. Repair and maintenance was 1 crore, you wrote 10 crore. So misstatement is there 9 crore. Okay. Sales were 100 crore, you wrote 10 more, 1000 crore. Okay. So inflated by 990 crores. Okay. These are misstatements. Okay. Continue. Now let's start. Evaluation of, what if you identify misstatement? What to do? That's the standard. Objective of auditor is, number 1, effect of misstatement identified on audit, effect of uncorrected misstatement. See, listen, these are total misstatement. Out of them, some you will correct. What about uncorrected misstatement? So this standard deals with 2 things. Effect of misstatement identified during audit. Out of that, some you will correct. Effect of uncorrected misstatement. Then identify uncorrected. Okay, start. Number 1. Auditor will accumulate all misstatements identified during audit. First, identify all the mistakes which you have found during audit. Auditor will decide whether we need to change overall audit strategy, overall audit plan. When will it change? When misstatements are more than materiality. Means there are material misstatements. See, auditor will decide whether to change overall audit strategy, overall audit plan. If circumstances indicate other misstatement exist and aggregate of misstatements identified could be material. See, in two changes, we will decide to change strategy and plan. Number one, if circumstances indicate other misstatement exist, or okay, aggregate of the all the misstatements could be material. Okay, then, if it could be material, will request management. Auditor will request management to identify all the misstatements, okay, to know actual amount of misstatement, so we can make an entry in the financial statement. See, when there are a lot of misstatements, we'll tell management to identify more misstatement in particular class of transaction, P&L, account balance, balance sheet, disclosures, to know actual amount of misstatement, so we can pass a journal entry. Okay, next, as soon as you know actual amount, tell management to correct the misstatement. Management, please correct this. They will correct some they will not correct. If they refuse, then see whether the financial statement are free from material misstatement. Very simple. Again, we will do till here. Come here. Auditor will accumulate all misstatements identified during audit. Auditor may also change audit strategy and audit plan in two situations. When they believe there could be more misstatement, or total of all the misstatement could be material. Whenever such thing is there, we will tell management to identify. Management, please identify more misstatements, so we can know the actual amount of misstatement and we can correct the same. Okay, tell management to correct. If they correct, very good. What if they don't correct? See the effect whether financial statement are free from material mistakes. Small mistakes they don't correct, okay, are they free from material misstatement? If they don't correct, also tell to those charged with governance, TCWG, those charged with governance. Okay, the auditor shall communicate with those charged with governance uncorrected mistake and their effect and request them to be corrected. We will tell to TCWG these are uncorrected, some they have corrected. Okay, request that please correct them, and effect of uncorrected misstatement of prior period. These are of prior period. See, management doesn't correct. Whom we will tell? TCWG. TCWG, these are uncorrected misstatements. You are dead of management and their effect, and request that please correct this. Effect of uncorrected misstatement related to prior period also we will tell. Very simple. Management corrects, very good. If they don't correct, we'll tell TCWG. Okay, the uncorrected misstatement and their effect and request, please correct them. Or uncorrected misstatement related to prior period also we will tell. Come here now. Find out the effect of uncorrected misstatement. Okay, see, prior to evaluating effect of uncorrected, auditor will again calculate materiality. Prior to finding the effect of uncorrected, again see, why materiality? Many times they have corrected the misstatements. After correcting, sales figure will change, expense figure will change, profit figure will change. If they change, okay, then again recalculate materiality, because materiality is usually 0.5 to 1% of sale. If sale has changed, materiality has changed. Materiality is 5 to 10% of profit. Okay, prior to evaluating the effect, see, some they have corrected. Now we are seeing the effect of uncorrected. Whenever you see uncorrected misstatements, what do you mean by uncorrected? Sir, those which are not corrected. Very good. Prior to evaluating the effect of uncorrected, because some are corrected, we will again calculate materiality, because profit must have changed, sales must have changed. While seeing the effect of uncorrected, what we will see? Size and nature of material misstatement. You have to see the size. Size means what? Okay, amount we have to see. Nature means in which area it is. Size and nature of misstatement in relation to particular class of transaction, account balance, disclosure, and financial statement as a whole. See, sometimes for particular account it will be material to consider performance materiality, but in terms of whole financial statements it's immaterial. Whenever you see uncorrected misstatement, you have to see the size and nature of misstatement in relation to particular class of transaction, account balance, disclosure, or financial statement as a whole. An effect of uncorrected misstatement related to prior period. Prior period also see. Last, take WR from management. WR you have to take from management or TCWG that they believe. See, majority they will correct. If they don't correct, okay, then take written representation that misstatements are immaterial according to them. If material, they will correct. Otherwise, what will happen? Qualified report. If they don't correct, qualified report. When will qualified report come? When financial statements have material misstatement but they are not pervasive. Okay, so they will always correct. But if they don't correct, take WR from management, where appropriate TCWG, that they believe that misstatements are usually they will correct. Okay, but if they don't correct, they are immaterial. They are immaterial. Auditors shall request management, where applicable TCWG, where they believe, okay, that misstatements are immaterial individually and in relation to financial statement as a whole. Last, will document. What will document? Amount below which misstatements are immaterial. All misstatements identified during audit. Auditor conclusion whether uncorrected misstatements are material or immaterial. Okay. Over. Time pass standard, 5 minute standard. Again, I will summarize. Okay. Evaluation of misstatements identified during audit. What is misstatement? Mistake. Okay. So number one, as soon as you identify all misstatement, see whether we need to change audit strategy and plan. In two situations, when there is a scope for further misstatements. Second, when all the misstatements could be, total of all misstatement could be material. We will request management to identify more misstatements, okay, and find out the total amount so we can correct the same. If they correct, very good. If they don't correct, see whether the total of misstatements, okay, uncorrected misstatements is material or not. If they don't correct, we'll go to TCWG. Please, 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 these are total misstatements, correct the same. Okay, or this is the effect of prior period misstatement, correct this also. If they correct, very good. If they don't correct, then what I will see? Evaluate the effect of uncorrected misstatement. Before seeing the uncorrected misstatement, I will again calculate materiality. Why? Because profit must have changed, sales must have changed. Whenever I see uncorrected misstatement, I have to see size and nature of misstatement in relation to financial statement as a whole and particular class of transaction account balance disclosure. I will also see the effect of prior period misstatement in relation to financial statement as a whole and particular class of transaction account balance disclosure. Last, I will take WR from management, that the WR from management or TCWG that they believe misstatements are immaterial, because if they are material, they will always correct because they don't want qualified report. Shareholder will never invest. Okay. Last, I will document amount below which misstatements are immaterial. Okay, that's 5% of materiality. Below that, all is immaterial. All misstatements identified during audit. The effect of uncorrected misstatement, whether that's material or immaterial according to the auditor. Okay, I hope it's clear. With this, we are done with 6 standards beautifully, amazingly. WR from management 580. After 5, 6 will come subsequent event. After 5, 6, if you don't do, 7 will happen. Going concern 570. Okay, asset 260, communication with TCWG. Asset 265, deficiencies in internal control to TCWG and management. 450, evaluation of misstatements identified during audit. Hope this standard was super easy. This was little complicated chapter, but we tried our best to make it super easy, super fun, and super interesting for you. If you like the lecture, do give a like button. Without subscribing, it's not allowed to go. Okay, if you put a nice comment, we will be very, very happy. Thank you so much. See you until then. Until next video. Bye bye. Good night. Take care. Thank you.